Hi there, welcome to Kneppy Invest and welcome to another technical update video. It is July 28th, 2024. Current time is 11:02 a.m. on a Sunday, which means because it's the 28th, we only have how many days in July? 31st, 31. So that means we have 3 more days in July. It's going to be busy. Plenty of smaller companies on the ASX will release their Appendix 4C, Appendix 5B, mining activities reports, those sort of things. So I do tend to be a little bit busy this time of year. And then we move into my favorite month of the year, August. We see a lot of companies releasing their financial year results. We've already started to see companies release their results. Corvests, code KOV, released their results on Friday afternoon at 4:06 p.m. Sneaky release during the closing auction, which means no one was able to trade any shares in Corvus after seeing their results. Now, I have not had a look or deep dive into these results. Now, the cynic in me would say these results were probably worse than expected or bad just because of the timing of the release. But that's just me being cynical. Maybe they were good. I don't know. Haven't had a look at them yet. They also released a presentation, so I might have a look, and a press release. So I might have a look at that either today or tonight, or at the latest tomorrow morning. And then after Corvest, typically it's Credit Corp. A few other companies have released their results, but these are like fund managers and really small companies. And then typically the second company that I wait for to release their results is Credit Corp. Now, don't believe Credit Corp have released an announcement in regards to when they're going to be releasing their results. No, but typically you will see financial year 24 results calendar. There should be some sort of calendar out there. ASX. We'll put ASX because some of these might not be ASX. So we have one from ASX Online. Not sure if that's going to be good. Comsec does a good one. Here's one from MarketDex. Haven't looked at this. This one from List Corp is from last year, so that's not relevant. So I haven't not looked at this one. Oh, this is just a date. It's nothing about company specific. Here we go. Here we go. I'm so pretty sure this is Motley Fool. So they have Credit Corp releasing the results on the 30th of July. I would have actually guessed the 1st of August. And then on the 31st of July, they have Rio Tinto and Centuria Industrial REITs. And then on the 2nd of August, so apparently no one's releasing anything on the 1st, we have Block, Pinnacle Investment Management, and ResMed. Let's just have a look at Market Index. Do they have anything different? So yeah, they've got Credit Corp on the 30th, Pinnacle Investment on the 30th, Rio Tinto on the 31st, and then the following week we have Satire on the 6th, AGL, Acadium Lithium, Coronado, AMP, Transurban, Charter Hall Long WALE, Mirvac, Temple Webster, and QBR. I don't think this is a comprehensive list of companies releasing results, but it does tend to get quite hectic in the third or fourth week, and then the last week tends to be a little bit more quieter. So I am quite busy during August, busy the last few days of July and busy in August. And I don't mind it. Although I do get a little bit sick of the Appendix 4Cs and 5Bs on the last day of July, which is that Wednesday? I would say it's Wednesday. Yeah, Wednesday, 31st of July. I know. So a hectic few weeks in store for people like me. Maybe not for you. Maybe you don't really care about results. I don't know. We're all different. Anyway, I'm getting a bit of a tangent here. The whole point of this particular video is looking at charts, technical analysis. And to be honest with you, financial results can influence the movement of share prices of companies, which will affect the chart. Not only the charts, also the volume. So what is the agenda for today's technical analysis update video? We'll look at indices. In fact, I have subtly changed my technical update video watch list in TradingView, so I don't have to move from one watch list to the next. And I've also changed some of the indices and also some of the commodities. So we have a look at indices, Australian, American, maybe DAX, FTSE, Hang Seng, Nikkei. Have a look at those. If there's another indice you would like me to look at, I can always put that onto the list. For instance, there is a South African follower, Anderson, who for some reason likes Palladium. So I always look at Palladium. So if you like a commodity that I don't include, in this particular video, maybe you like cows or wheat. Just tell me and I'll have a look at it. Why not? Always willing to have a look at something I don't usually look at. So have a look at the indices, have a look at commodities, including gold, silver. Uranium is one of the charts I have updated. Oil, maybe copper. Definitely have a look at copper. Maybe have a look at coal, nickel, palladium. Maybe have a look at cocoa. Then we'll go into cryptocurrency, bonds. Always want to have a look at cryptocurrency and bonds, and then a few individual companies' charts, about 10 to 12, including one company listed in the United States. And this company's share price rose 23% on Friday. And this is a fairly controversial company, but they had a good court case ruling or something. And you probably know one of the products this company sells. It's fairly controversial, but the chart looked really interesting before Friday. I took a position in this company because of the chart, and I had no idea this was up and coming for the company, and the share price rallied 23%. So I'm a pretty happy camper right now, just because I took a position based off the chart. Anyway, so let's start this particular video focusing on the Australian indices, starting with the XJO, the ASX 200, a little bit different than the XAO, which is the ASX 300. I don't know why I focus on the XJO when I probably would prefer the XAO, to be honest with you. The XAO is the top 300 companies. But to be honest with you, there's not much difference between the two. The XAO tends to be a little bit higher than the XJO, which makes sense because it's 300 companies, not 200. Anyhow, this is the XJO over the past, this is the daily chart over the past, just over 1 year. And a negative week. I think the XJO was down about 0.6%. But when you do have a look at the weekly chart, what's there to complain about? It's still an uptrend. It's been an uptrend for 15 years. It's been in a trading channel for 15 years. We are nearer towards the top of the trading channel. That's my one concern I would have. If I did have a concern, I'd be a little bit more excited if we were at the bottom of the trading channel, like we saw back in or towards the middle of 2022 during COVID-19 financial panic, and at the end of 2018. So, and when we get towards the top of the trading channel, I tend to be a little bit more bearish, like we were just before the COVID-19 financial panic. We got to the top of the trading channel, and that's when I sold a lot of my positions. It was just fortuitous timing. Look at it. We literally, in fact, I just moved it. We literally were at the top of the channel the week before we crashed, and it was just fortuitous timing. And I just remember, I was a little bit more bearish, and right around then, or coming into COVID-19, we saw a yield inversion, and yield inversions typically mean there's a greater chance we move into recessions, and that held up true. But this was a black swan event. No one saw it coming. Well, until like the late January. Late January is when we started to. Some of us started to realize, there's something going on here. What China's doing. Anyway, I'm getting ahead of myself. Not ahead of myself. I'm going on a bit of a tangent here. So whenever the market is at the top of the trading channel, I tend to be a little bit more bearish, but not a lot. But overall, we know that over time, the markets rise. So if we're talking about 10 years, I'm bullish, absolutely 100% bullish. However, I did listen to a podcast today, not for long, and apparently there are some people who think we're going to go into a Great Depression in the 2030s. I'm not sure why, but there are some people who believe that. I'm not like that. I think over time, we're going to see the market rise in 10 years. I'd say it's 95% likelihood we're going to see the XJO higher than it is right now. I think it's without almost an absolute certainty. Not 100%, but an absolute certainty. Well, that's bad, me saying absolute certainty, because that is saying 100%. I think it's within a high chance. I'd say it's a really good chance we're going to be higher in 10 years' time. So this is the trading channel. This is a weekly chart. Beautiful uptrend over the past 15 years. Trading in a channel. That channel is or has no signs of being broken. In fact, it's only been broken twice in 15 years. I've talked about that in previous videos. I'm not as bullish when it comes to these small caps. For some reason, I said for some reason, I know why. Generally, that's the most important word here. Australians don't like small caps because they're not dividend paying. Australians are obsessed with dividends, and a lot of small cap companies are not profitable and they don't give dividends or high dividends or that sort of thing. But you can pick and choose when it comes to small caps, and you can make a mozza. And I think it's all about stock picking when it comes to small caps. I would never invest in small cap funds unless they had almost the identical strategy as I do. And I think that's almost impossible. I don't invest in small cap ETFs. Again, for the same reason, I prefer to be a stock picker. And you can just see here by the small caps weekly chart, we're still not at the highs we saw back in 2007. And that shows me that small caps have been weak in Australia for almost 20 years. It might turn around, and I think eventually it might turn around. And the other thing to notice, or to know, but that when small caps actually grow into bigger companies, they get turfed out of the small cap ordinaries into the larger cap ordinaries. So those companies that are growing leave it. And I think that's another reason why the small ordinaries doesn't tend to perform as well as the XGO or the XAO. But anyway, the other thing to note about the small ords is let's have a look at the daily chart. 2 down weeks in a row for the small ords, and sort of is right now trading in a bit of a channel. Hasn't been going on long this channel for maybe about 5 months, and we really need to see the XSO get above about 3,120 to probably confirm to me that we are now in a nice developing uptrend. The last 2 highs have been fairly weak, not quite as high as the highs we saw back in April. So there is a bit of resistance between about 3,080 and 3,120. And right now, the XSO is actually just below 3,000. Really bad day on Thursday, down at 1.77%. Okay, so I'm much more bullish on the XJO versus the XSO, but I'm much less bullish on the Australian markets compared to the American markets. So let's pivot to the American market, starting with the NDQ or the NASDAQ. And we have seen a little bit of a pullback. Is this anything to be concerned about? In my thinking, no. We have seen plenty of pullbacks in this current bull run in the NASDAQ. In the most recent pullback in April, it did pull back. It looked a little bit nasty for a while. And if you sold out completely on the 19th of April, you're probably regretting, or probably did regret, that. We also saw a probably nicer pullback back between July and October last year, and then it went on a nice tear. And that was late October, early November was when we thought, a lot of us thought that there will be 50,000 interest rate cuts in 2024. We became a little bullish when it came to that, and that's why the market went on a bit of a tear. Of course, that's not happening. There might be 1 or 2 interest rate cuts in America. They're already doing it in Canada, in Europe. Might be an interest rate rise in Australia, by the way. I think that will be a mistake. But this pullback is just an opportunity, or a potential opportunity. I don't think it is weak. And if you go back through history, when markets turn from bearish or bullish to bearish, it doesn't happen like that. It takes time because a lot of that positive sentiment remains there for a while. It takes a lot of churn to shift positive sentiment into negative sentiment. And if you just go back, just ignore the COVID-19 financial panic, because that happened fairly quickly. If you just go back to the GFC, it took time. In fact, we have to go all the way back. Here we go. All the way back. It took time. It didn't collapse. So it took time. A really nice bear run or bull run for the NASDAQ or the indices. And then back in towards the end of 2007 into start of 2008, it didn't collapse. It moved from bullish into bearish, neutral, but the collapse didn't really happen until September 2008. So before that, it wasn't in a really well-defined downtrend. I think even during the bubble collapse, the dot-com bubble burst, if I remember correctly, it didn't burst like look at this. Got to the peak in March 2020. 2000. It fell a fair bit, but then it was starting to rally again, and then it moved into a downtrend in October 2000. So we're talking about a 6-month period before the uptrend was confirmed to have moved into, was confirmed to be at an end. And so plenty of time, plenty of signals before I would become bearish. So nowhere near enough time to have turned bearish right now when it comes to the Nasdaq, which is counter to a lot of tweeters or X's. So many bearish just because the market has dipped a little bit in the last 2 weeks or maybe 3 weeks. Could be just a buying situation, possibility buy the dip situation for the Nasdaq. Let's have a look at the Dow Jones Industrial. A little bit different, so a little bit more weakness in the tech companies. So some might say they're overvalued. I actually disagree with that. A lot of the P ratios of some of these tech companies aren't that high. In fact, if you compare some of these tech companies' PE's ratios to some of the Australian tech companies' PE ratios, it's night and day difference. Some of the Australian tech companies' PE ratios are well above 100. I had a look at, I think it was Microsoft the other day, or maybe it was Google or Alphabet. PE ratio like 25. Commonwealth Bank's PE ratio is like 23. Which would you rather buy, Microsoft or Apple? I think actually Microsoft's like 35. Which would you prefer? Alphabet, significant growth opportunities in the future. Compared to CBA, virtually no growth opportunities. I know which company I would invest in, and that is Alphabet. In fact, let me just have a look. Whoops. Alphabet share price has pulled back, and Alphabet has PE ratio of 24.26. Yes, 24.26, and I'm pretty sure CBA has a PE ratio of about 23.58. So the PE ratio of Alphabet and CBA are virtually identical. What would you prefer? What do you think has the greatest growth trajectory? It's not CBA. If you answer CBA, you are on the wrong path, my friend. Anyway, well, by the way, CBA's chart looks really good, but it's just significantly overvalued. Anyway, I'm going on a bit of a tangent here. Let's go back to the Dow Jones. It doesn't look as bad. It actually looks a little bit better, but there has been a bit of a rotation in America from tech companies to small caps, although I don't think there's many small caps in the Dow Jones, or maybe some of that rotation is not only in small caps, it's also to some of these industrial companies on the Dow Jones Industrial Average. So a good looking chart for the Dow Jones. A little bit of pullback, but a nice day on Friday, by the way. Friday was up 1.6%. It was a really good day on the American markets. I didn't realize that. Did not realize that. So we should have a pretty good day on Monday, huh? Yeah, anyway. The Russell 2000, which is a small cap proxy, well, they call it a small cap indice. So I'm going to go with that as well. And this looks pretty bullish. So this is all on the expectations that interest rates will drop. That's all it is. Expectations that interest rates will drop. So people are getting into these small caps because they believe possibly they're undervalued, or possibly they will benefit from falling interest rates because they're not profitable and all their future cash flows are well into the future. And all you have to do is a net present value calculations to know that a lower interest rate environment will be beneficial for those types of companies. So again, this just shows you there has been a little bit of rotation from the bigger tech companies into the small caps. But again, some of these tech companies are actually looking better value. Yeah, again, Alphabet, 24 PE compared to CBA. It's crazy. Okay, so it's a pretty nice looking chart for the Russell 2000. And possibly some of this sentiment, positive sentiment or shift in sentiment will transfer to small caps on the ASX. Possibly. You think it would. Yeah, if we're all being rational. Yeah. Nikkei. What's happened to Nikkei? A couple of bad weeks in a row. Nikkei has collapsed the last few, maybe not collapsed, that's probably a wrong word, down 3.8% 2 weeks ago or last week, and now down a further 3.5%. Maybe it's just rallied a little bit too much, but the weekly chart looks pretty good. Nothing, no complaints there. Hang Seng. This is one of the indices I've just transitioned from. I was looking at the Hang Seng, I think it was a 100, now it's just the Hang Seng index, and it looks really weak. No one likes China right now. Looks pretty weak. That's the weekly. Even the daily will probably look pretty weak. Yep. It started looked like it was trying to move into an uptrend, just like it did back in December 2022. But that possible strength has weakened. What about the DAX, the Germans? Nice looking daily chart. I assume the weekly chart looks pretty good as well. Yep. And the FTSE looks okay as well. Probably not as strong as the DAX and the American markets, but and probably on the same. You go back a little bit further, sort of similar to the. Maybe similar to the XJO. Maybe, yeah, maybe, yeah, maybe similar. Okay, so that's all the indices I want to talk about in today's video. Now let's have a look at some commodities, and we'll actually have a look at the daily charts for these. Let's start with gold. And if you have a look at the gold chart, any complaints? Now that gold did pull back the last few weeks, looked like it was going to break out 16th of July, so 2 weeks ago, and it has pulled back a little bit, but I wouldn't be concerned. I do have a few gold companies in my portfolio, and I'm not concerned. Gold still looks pretty bullish right now, unlike some of the other commodities. Some of the other commodities don't look bullish at all. Silver, actually have not looked at silver. Silver looks a little bit weaker. So there should be a fairly good correlation between gold and silver, but it doesn't always happen like that. So silver has pulled back. Not only pulled back, it's fallen through a support level. That happened on Thursday. Silver fell 4.6% on Thursday and fell through this support level. So silver definitely looks weaker than gold, but maybe more value in silver? I don't know. There's a few silver companies on the ASX. Adriatic Metals, I'm pretty sure, is that ADT? Yep, ADT. And I'm pretty sure the share price of this company has dropped like a rock. Yeah. I'm not sure this is correlated to silver prices. Something else is happening with this company, if I remember correctly. Don't follow this company all too closely, but it is moving towards an interesting level. 280 is interesting. But this portion of the video is not stock. I'm not looking at individual company stocks here, so let's move on to another commodity. Let's have a look at iron ore. Well, if you look at the daily iron ore chart, there's no reason to be bullish, is there? Iron ore, in fact, is more in a downtrend than anything else. And then if you look at the weekly chart, no reason to be bullish or bearish. It's really just going sideways. And a little bit of volatility in there, but I actually am neither bearish nor bullish on iron ore right now. I have actually no iron ore plays. I am regretting selling out of Phoenix. That is a really good iron ore company, a growing iron ore company, a diversified iron ore company. And in fact, that share price of that company is in a beautiful uptrend. Anyway, let's move on to the next commodity. I do have uranium here, so let's have a look at uranium. So this is one of the ones I've changed. This is now Sprott Physical Uranium. The reason I like this one is because if you look at the daily chart, you don't need to change to a line, or look at the weekly chart. And this is interesting. So this is starting to look a little bit more bearish, isn't it? Starting to look a little bit more bearish. Looks like it's trying to move into a downtrend. So yeah, and yeah, a little bit more bearish on uranium. And this is quite apparent when you look at individual companies, uranium companies' charts. They are all starting to look way more bearish. I know this is not supposed to be individual companies' chart portion of the video, but let's have a look at some of these uranium companies. Boss Energy, starting to look quite bearish. It's fallen through support. Let's have a look at Palladium. I'd say this is starting to look quite bearish as well. Yep, starting to look bearish. In fact, it's showing the telltale signs of a downtrend. Lower high, lower low. What's another one? Let's have a look at Bannerman. And we'll have a look at Deep Yellow. Yep, Bannerman starting to look a little bit more bearish as well. What about Deep Yellow? So it's starting to look more bearish as well. Maybe not as bearish as some of the other ones. And I probably am missing a few others, but that's all I'm going to talk about right now. So starting to look a little, uranium starting to look a little bit bearish than it has in the past. What about oil? This is another one of those commodities I'm neither bearish or bullish on. And you can just see that by the chart. This is a daily chart. There's just no trend. In fact, there's been no trend for probably almost 2 years. We'll say a year and a half. There was a bit of a downtrend before that, but right now there's absolutely no trend. And you can just see there's no trend just by all these crosses. These little crosses here, all these add plus addition signs, is a change in or a crossover in the moving averages. And when you see a lot of them like this, that means there's just no trend. So you can see there's one cross here that was a movement from oil going in from an uptrend into a downtrend, and there was a long period of time when there was no crossover. And if you have a look at the weekly chart, again, I don't think I'd be, there's just meh, it's just meh, just going sideways. Which is interesting because if you have a look at oil has not moved for the last almost 20 years. The same price for 20 years, which means oil companies have not been a good investment for the past 20 years. Anyway, what about natural gas? Is there a trend in natural gas? And the answer to that is no. This goes back 20 years. Nothing. Lithium. Would you be invested in lithium right now? No. Still in a downtrend. Still falling. I thought it might have reached a base or a bottom back in early of this year, but it's still falling. And again, if you look at an individual lithium companies' charts, they're all bearish. They're all pretty bad. Copper. A bad week for copper, was it ever? A few bad weeks for copper. In fact, if you look at the weekly chart for copper, we've had 3 negative weeks. Last week was down 7.8%. This week, down 2.7%. And it's fallen through a support level and quite easily. In fact, on the worst day, it fell through that. And that was on the Thursday, 18th of July, so 10 days ago, dropped 2.9% and just kept on falling. In fact, if I saw an individual company's chart look like this, I'd be extremely bearish. It's just selling. There's no enthusiasm from buyers, although the last few days for copper looks like maybe a possible bounce is in store. So a little bit of buying has come in and the selling has started to dry up. But not really any support levels at that. Maybe here. Okay. Coal is looking like it's always looked. Well, maybe not always, but the downtrend is slowly coming or unwinding. Probably the best way to put that. Tin has had a horrid few weeks. Has dropped off a fair bit. And I think that's pretty true for nickel as well. Nickel's had a really bad week. This is one where I have to look at the weekly chart. But yeah, nickel's had a few bad weeks. In fact, a few bad months. It's fallen for about 2 months in a row. And palladium. Let's have a look at palladium. The daily chart. No. Well, I was going to say there's no trend here. No, there's no sign that the downtrend is coming to an end. Maybe you could argue it's starting to move or show signs of moving sideways because the low we have seen was in February and palladium hasn't fallen below those lows. That could be a good sign. The low has been reached, but I need to see a higher high. That's what I want to see. But at this point in time, no trend in, well, there is trend, it's a downtrend, but there's no signs of that trend coming to an end. And let's have a look at cocoa. Why not? This could be a good case study. A beautiful uptrend in cocoa and accelerated from January to the peak in the price of cocoa in April. Beautiful uptrend here. And you could just study this. And you can see since then, there's a lot of volatility. And yeah, I would not have tried to trade cocoa during this period. And you could probably argue that on the 29th of April was really the end to the uptrend in cocoa, down 15% on that day. And it was a really negative day. So even though it dropped a lot, and I'm just thinking of Droneshield, by the way, looking at this sort of reminds me of Droneshield. So let's have a look at Droneshield. For those who don't follow Droneshield, yeah, this shows me same characteristics. Again, pattern recognition. History doesn't repeat, but often doesn't rhyme. I look at cocoa, and it just reminds me of Droneshield. And this is exactly what might happen. Let's go back to cocoa. This is exactly what might happen to Droneshield. You might see a lot of volatility. There might be some really nice runs for short periods of times, but I think the volatility will continue for Droneshield over the next few months. So more than likely, I won't trade Droneshield. Okay, so that's commodities. Now let's have a look at Bitcoin. It's moving towards 70,000. showing signs of a bit of weakness back towards the start of July. A couple of days where it fell through this support level. Support level is more like there. It's more like a zone. And I was thinking, oh, maybe I should sell my position in Bitcoin, but I went, nah. And it has rallied since then. And the important level for Bitcoin, in my opinion, is about 75,000. If it gets to 75,000, that would be a bear or a bullish sign. If, on the flip side, if it falls, say, to 50,000, that would be a bearish sign. And right now, it's in a trading channel, and it has rallied in the past month. And probably the same thing with Ethereum, I would assume. Well, no, Ethereum's a little bit weaker. Ethereum's a little bit weaker, and I've just put this purple box. That is an important zone for Ethereum. That's a support zone. It fell through that zone, so below 2,700, that would be fairly bearish for Ethereum. Now let's have a look at bonds. We'll only have a look at the US 30-year bonds, and the daily chart tells me there's no trend. So the bond market is saying, we don't know if there's going to be interest rate cuts or rises. We don't know. Well, maybe not rises, but when are the interest rate cuts going to happen? So I have heard chatter that there's a 100% likelihood of an interest rate cut in, was it August or September? I don't know about that. I don't know. We're going to have to see some further proof. However, they have started to drop interest rates in Canada and also Europe, but there's no trend in bonds yield right now. And this would play out with the Australian 10 years. Very similar, no trend at all. Okay, so that's the commodities, Bitcoin, and bonds. Let's have a look at individual companies' charts. I'm going to start off with two airlines, ANZ and Qantas. Now, I want to do a standalone video on Qantas because I was listening to the AusBiz The Call, and someone said, I think Qantas is a buy because the PE ratio is 6. And I was like, okay, but is that on the back of some elevated earnings over the last few years because of they were able to sell air flights at a much higher rate, cost or rate or whatever you want to call it, than they should. So profit gouging, that sort of thing. Is it on the back of that? I had no idea. It was sort of my hypothesis that the PE ratios of Qantas was really low because of higher than usual earnings because of that. And then I had a look at Australian or Air New Zealand, and I went, well, if this analysis was really keen on Qantas because it had low PE, well, they should be really keen on Air New Zealand. I wouldn't say Qantas is a better quality company than Air New Zealand. I think that would be drawing a long bow. But then just have a look at the charts for these two companies. It's completely different. Now, Air New Zealand has gone on a run the last week, which is really interesting. It's gone from 48 cents to 54 cents. But before that, it was a well-defined downtrend. Fell from about 72 cents down to 48. So it actually fell by 33% over a fairly short period of time. And then have a look at Qantas. Yeah, in fact, during the same period, Qantas share price has risen. But have a look at the PE ratio of both companies. So Qantas has a PE ratio of, just going to have to raise that, PE ratio of 6.5. Again, is that on elevated earnings? And Air New Zealand is on a PE ratio of 6.23 and has actually risen because the share price has risen. So if this person was really keen on Qantas, they probably should have been keen on Air New Zealand. Now, I am not a big fan of airlines. I think they are crappy investments. In fact, if you have a look at, say, the monthly chart for Air New Zealand, yeah, this is the monthly chart going back to 1998. It's not an investable company. I think it's even true for Qantas. I don't think, yeah, this is Qantas's monthly chart going back to 1996. There's no, yeah, in fact, yeah, there's no reason to be invested in these sort of companies for the long term. In fact, the only time I've even thought about buying Qantas shares was back in 2013 when the share price fell below $1 or close to $1. And even then, there was a lot of concerns about the future of Qantas. And I'm just kicking myself because it was so obvious that Qantas wasn't going to go anywhere. And buying this company at $1 was, to be honest, a bit of a no-brainer. But a lot of people just didn't want to go there. And I was one of those people. In fact, that's the only time I would buy one of these companies, not high-quality companies, not the sort of company you have in your portfolio for the long term. I doubt even the dividend yields are high. In fact, according to this, Qantas doesn't have a dividend yield. Okay, let's go on to some other companies that I'm looking at. I'm going to move the final company, not that company, last. That's the only overseas company on this list. So let's go to this company called McPhersons. I'm pretty sure this has nothing to do with L. McPherson or McPherson. Well, I was having a good look at the daily chart for this company just yesterday, and I was like, it's an interesting level. And what is that interesting level? It's a support level, a really strong support level. Maybe not strong, maybe that's not the right word. And you can see why it's strong or a support level. Maybe strong is debatable. And that level is 38 cents. So the share price of this company got down to 38 cents in July last year. Really struggled to get below 38 cents in November. And the share price is just above 38 cents right now. And I think it's showing signs of possibly bouncing. Share price, I think, was in a downtrend, and share price has just been going sideways for the last 3 or so weeks. So has it found support? Definitely not a high quality company, but PE ratio, this company has been pretty sure profitable in the past, but market cap of 60 million, dividend yield of 7%. Now, this is not a growth company. In fact, revenue probably flat over the last 5 years at around about 210 million, but it has been profitable some years. Last year, it was loss-making, but as profits as high as $13 million in 2019. So that has that potential, and the share price has fallen a fair bit from 2019. Well, 2020 was when it got to its peak. Got to $3.40. Now it's at 40 cents. So possible support level for McPhersons at about 38 to 40 cents. So for those who don't mind playing that sort of play, this could be a value play. Possible value play. And I do like value plays when it comes to charting over companies that are definitely overvalued, but the chart looks good. CBA comes to mind. Chart looks brilliant, CBA, but it's definitely overvalued. A company like this might be really undervalued, and it's technically it's at a bounce level. So yeah, so I much rather play trades for undervalued companies or cheap companies than overvalued companies. I think, not I think, research actually suggests that there is better value or better chance of success, better chance of beating the market if you do if you do trade based off valuation. So maybe play here. I'm not sure if I'm willing. Let's have a look at one company. I'm going to just show you one company I'm trading. Let's Shape Australia. Now, I talk about sometimes volume isn't very important. So I just wanted you to focus on volume here. So volume is found in the bottom. If you go back to 2022, 2023, which is the start of this period, share price was in a downtrend. There was no volume. Very, very weak volume, which tells us the market's not interested in this company. Now, this is a profitable company. Is it a growth company? Maybe a little bit of growth there. It's a dividend-paying company. Dividend yield right now is 6%, which is crazy. PE ratio 15.6. So back then, in the middle of 2023, so we're talking about 1 year ago, the share price of this company was as low as $1.35, so almost half what it is now, which means the PE ratio would have been like 7 or 8, and dividend yield might have been 12%. And then we started to see sentiment shift. Not only that, if I just go like this. So this company listed in late 2021. We started to see the volume. I don't know if hopefully you can see that. We started to see the volume increase in August last year. So around the time the company released their results, we started to see the volume increasing. And that's a good sign that the company releases the results and then someone goes, or maybe a few fundies, few investors go, there's something about this company. They don't look at the chart. They just see some valuation or some possible good value in the company, and they start buying shares. And we saw that increase in volume being sustained. That's another good sign. Not only that, we started to see the share price rally. So volume increasing, share price starting to rally. So I started to become interested in this company. It took me a little bit of time to buy or take a position. When I say time, it took me about 4 months. I needed a breakout. I need confirmation. But then have a look at the volume. So the volume has really expanded in this company over the past year. So that little bit of increase in volume in August is being dwarfed by the increase in volume we've seen in 2024. Not only that, look at the volume increase in July. Massive spike in volume on the 3rd of July, and we've seen sustained increase in volume. I think there is a definite, and not only that, look at the chart. So remember, we've had a few bad days. And whenever we've had a bad day in the market, this company's share price just holds up. There's no selling. No one's selling. And I just think the only selling we've seen was in March. Actually, 29th of February. On that particular day, they went ex-dividend. That's the only really selling we've seen. And there wasn't much volume. And that was the only time I've been nervous. Not nervous, but I went, what's happened here? And then I saw they went ex-dividend. But yeah, there's just no selling this company. I'm really looking forward to the results this company provides. I think they're going to be quite good and possibly surprising the market because no one wants to sell shares in this company just yet and increase in volume. And this is why sometimes don't listen to AusBusinessCorp, those experts who say, oh, it's just a lobster plot. You can't, it's not investable or uninvestable because it's a lobster plot. Ignore a pot. Ignore those people. If shares in a company are hard to get out of, they're hard to get into. If they're easy to get into, they're easy to get out of. What they assume is you buy on market and then sell at a limit order. But if you sell at a limit order, you should buy at a limit order. If you sell on or buy on market, you probably should sell on market. In fact, if you sell on market, they're easy to get out of. And this is a case of a company that was illiquidly traded. Liquidity is improving as the company becomes more well-known, as fund managers get more interested in the company. And in fact, some of the best earners over the past 15 years have been low liquidity companies. And one of the reasons and one of the benefits we have as individual investors is we can buy these sort of companies and over, say, fund managers. And a lot of fund managers would have refused to buy Shape Australia because liquidity was quite bad. And eventually, when the share price has quadrupled or 10-bagged, that's when they become interested because liquidity has improved. So I always ignore, whenever I hear an analyst, an expert on AusBusinessCorp say, wow, this company is a lobster pot. Ignore them. Ignore them. They are taking the viewpoint of a fund manager who has millions and millions of dollars to invest in. That's when it becomes a lobster pot, not for individual investors. And they're just not catering for us. They're just looking at the viewpoint of a fund manager. Anyway, rant over when it comes to lobster pots. Okay, so a few companies that are on my radar for various reasons. The first one is Perenti. And this one is starting to look interesting. I'm starting to think we're starting to see the share price of this company trying to move into an uptrend. It's actually got a cross here, which is a crossover between the 50-day and 200-day moving average. Share price is trying to break out to at least 3 months high. In fact, 6 months highs. So this is definitely on my radar. Perenti. They also released some good news. Was it last week? Yeah. Another company has my watch lists, probably on a lower tier than Perenti in terms of whether or not I'm going to take a position in the company, is Helios. So one of these, what do you call them? Same thing as Australian Clinical Labs, Sonic Healthcare, a diagnostic sort of company. What do you call them? This company has been hammered over the past few years. Share price is really low, but it is showing signs of turning around. So definitely signs there of the share price turning around. And just talking about volume, look at the pickup in volume as share price got really low. We started to see volume increase. We really saw it increase on 22nd of November. This would have been the AGM. Share price dropped 28%, and that was the end of the bad news. And that was almost a low. And then we saw a bit of a double bottom here in March and May, and the share price is trying to rally. Moving into an uptrend, trying to move into an uptrend. So there's definitely, Helios is definitely on my radar. Biome is on my radar for a different reason. We have seen the share price fall back. I would say they did release their Appendix 4C, was it last week or the week before? And I did think it was an underwhelming Appendix 4C. And I think we didn't see much of a reaction from the market on the day, but the share price has really pulled back in the past week and a half. In fact, in the last week, the share price fell 24%, and the previous week it fell 10%. So we have seen a bit of a pullback. My question is, how much longer will the selling continue? We're seeing pretty good volume coming through. So I do think the market did eventually find the Appendix 4C to be a little bit underwhelming, but I'm not sure how much more the selling will go on and how much more the share price will drop. I put a line right here. This level here is going to be really important, around about 42 cents, because that's the highs we saw back in March March. And then when the share price broke out, that was the level I was looking at on the 18th of June. In fact, it was the next day. The 19th of June, share price broke out on that day above 42.5 cents. So that's an important level. If the share price can hold above that and start to rally off that, that would be a good sign. But at this point in time, no insight to the selling. But definitely one on my radar is Biome. Polynovo, I think this is looking pretty good. This would probably be on the same level as Parenti, maybe even above Parenti, because I do like this company a little bit more in terms of longer term hold. I think this company has a longer runway for growth, but it is valued quite richly. And that's my one concern about Polynovo, is they really need to have to prove to the market they can grow significantly. And if they can't, the share price will collapse. But the chart is looking good. And this level here, 260, is important. Level 250 was important as well. So this sort of zone between 250 and 260 is important. And it rallied nicely on the 24th of July, but has pulled back the last 2 trading days. This could be a bit of a pullback by the pullback situation, but I am liking the chart for Polynovo. I was trading this, and then for some reason I sold out, took profits, and I'm thinking, why did I do that? Yes, why? And I bought on this breakout here in January, and then I sold, took profits. Don't know why. Anyway, Data 3, another one on my radar. So we can see a fairly big drop in share price back in February. So this would have been on the back of the results, I'm assuming. So that was a bit of a red flag. And then we saw the share price do nothing much for about 5 months, February, 5 months. But it is showing signs of moving into an uptrend. Not the best signs, and would have loved to see the share price not rally back in January. If the share price remained below 860, I would be way more bullish on this, because there would be some shareholders who bought at higher prices, and there would be a little bit of resistance. Evaluation of this company as well. It has a PE ratio about 33, 31.87. Okay growth, but I would love this company to be a little bit cheaper, and then I'd be maybe a little bit more keener, but definitely one on my radar, Data 3. Change Financial. This is showing signs of turnaround. A few reasons I'm interested. Definitely the chart, or share price action, looking really good. They also released their Appendix 4C and looked pretty good. I think the market is aware of that. And the volume, look at the volume, really increasing the last month. Really starting to increase the last month, and that's a good sign. In fact, the volume really started to increase in this company. We can't really see it there. Sort of at the end of 2023, or the middle of 2023, and that was sort of towards the bottom in the share price. And now we've started to see the volume expand. That's a good sign. So that's Change Financial. P ratio, actually the markup of this company is 454, and no P ratio. So don't really know about the valuation. My one concern about these companies is no real, by the way, you can see my client ID. It does not matter because I have no money in ComSec. So some viewers have been concerned that you can see my client ID. The other thing is my password is almost impossible to break, and I change it all the time, even though I have no money in ComSec. So anyway, I don't trade through ComSec. I just use the platform because I really like the platform, but their fees are just too high, too stupidly high. They have dropped them over time, but still really high. What was I going? Oh, Change Financial. Change Financial to release their Appendix 4C on the 25th of July. I'm pretty sure I've mentioned this company. Can't remember, and I just remember it was pretty good. I was just remember going, oh, this is definitely a company to follow. And let's have a look at the numbers quickly. Yeah, operating cash flow positive, but not free cash flow positive, because they have intellectual property. And in my opinion, intellectual property, it's capitalized research and development, belongs in the cash flow from operations. It's just my opinion. No, not the cash flow from operations. It should be alongside capital expenditure, property, plant, and equipment, in investing activities, because it is investing activities. Research and development is investing for the future. Anyway, that's just my opinion. So yeah, Change Financial chart looks pretty good, and the volume has me impressed as well. Don't know if I'll take a position just because, yeah, it's a smaller company, not quite profitable just yet. It's on the precipice. It's hitting that inflection point. Share price could pull back significantly if they disappoint for one moment. Woodside. I have mentioned this. Woodside was featured again by, not again, it was featured by Gary Glover on Ausbiz Core. It was his biggest trading position. And I just did not understand why. Share price in a downtrend. I think, if I remember correctly, it hit $27, which is a support level, granted, and it showed signs of taking off. But yeah, it's a commodity, and the share price has completely pulled back. I'm pretty sure their quarterly report disappointed the market, and the share price is back to $27. But $27 is a support level, so you can't ignore that. But the more times the share price of a company hits support or resistance level, it weakens it. It weakens it. I actually believe that now. It weakens it. I always thought it strengthened it, but I think it weakens it. And you can just see the share price of Woodside just moving, just hitting $27 numerous times in the past 3 or 4 months. First time was the 2nd of May, and then numerous days in June, it hit $27 and then eventually rallied. Now it's back at $27. You can see how strong this level is. So a lot of people see the share price of Woodside at $27 and go, oh, it's $27. I'm going to buy some shares. But on the flip side, you also have people selling because the financial numbers from the company, released from the company, have been disappointing. Definitely, this is not a long-term hold. This is just a trading company. The reason I say that, and even though it's natural gas and oil, it's diversified, if you have a look at the monthly chart, it's gone nowhere over the past 20 years. In fact, $27, the first time the share price of Woodside got above $27 was in June 2005, 19 years ago. You bought on that date, your capital in this company has not grown. Just imagine you bought in 2007 at $67. Your capital significantly decreased. Not a high quality company, and I will back that up. In fact, I think this is one of the weakest companies in the ASX 20. On the flip side, I don't think Insignia would be considered a high quality company. This is the monthly chart for Insignia. The share price, talk about support levels. So back in 2009, share price of Insignia got down to $2. And look what happened in the past 2 months for Insignia at $2. And just let's look at the daily chart. Yeah, Insignia share price really has, just stayed above $2. $2 is an important level for this company, as you can see. But I don't care about that. I cared about two things in regards to this company. You can see the share price taking off and a volume increasing as well. Company released their quarterly results, or the quarterly numbers. And I still remember the one person I was visiting who said, well, Insignia are not really interested, but if they did show that they can increase their funds under management, that could be a good sign moving forward. And that's exactly what this company did. And that's exactly why the share price has rallied, because their funds under management grew. There was inflows. I think inflows is a better word to use here. There were inflows instead of outflows. So now could be a time to be interested about this company. So the quarterly business update, I think I might have mentioned this company, I can't remember. Return to positive net inflows. That's the first highlight point they made. And it was really interesting. I read that, listened to this podcast, and virtually the next day I saw this announcement. I went, oh, hello there. So yeah, Insignia is definitely on my watch lists. And who knows if this could be a turnaround point for Insignia. I'm pretty sure they have made some acquisitions, but you look at the share price high, over $11. So does that mean it's going to get back up to $11? No, but it could. It could. That was not that long ago, by the way, 2017, 7 years ago. And finally, we'll get to 3M. I think it's pretty sure it's 3M, not Triple M. And this is listed on the New York Stock Exchange. Let's have a look at the monthly chart first. In fact, the monthly chart looked pretty good. If you look at this, you go, wow, that's a brilliant chart, 3M. But since the peak in the share price back in 2018, share price has floundered But you notice in the past month, share price has rallied 24.4%. It's all been the last week. Share price up 22.4% in the last week. Then if you look at the daily chart, share price went up 22.99% on a Friday. And I was like, oh, they must have released their results. And then some of you might know this. And then I saw this Roundup. News slow. Federal court finds insufficient evidence. Roundup weed killer causes blah, blah, blah. Major class action thrown out as federal court finds insufficient evidence. And who is the owner of Roundup? Oh, I thought it was 3M. I always thought it was 3M. I could be wrong with this one. I assumed 3M rallied because of this court case. And I could be wrong. And I would admit if I'm wrong. 3M share price. Why did it rally? Let's have a look at the news. Maybe it is. Maybe it is. Oh, no. I was initially right. Okay, I always thought that 3M owned Roundup. That's always what I was thinking. But according to this, a rally as profits soar. So this is better than I expected. And the reason it's better than I expected, here it is. 3M stock price jumps 20% on or to 2-year too high on strong earnings guidance. Yeah, so I am completely wrong. Now, the reason why I was interested in this is I took a position in this company back here because of share price. It's just based off the chart. So this share price of this company was in a downtrend. And I just had a look at this and I went, oh, it's showing signs of turning around. So I'll take a position in this company. And I'm pretty sure it's a chemicals company. Pretty sure it's a chemicals company. Yeah. Well, they have a lot of segments. Gee, they do a lot. I don't know. I always thought 3M owns 3M and Roundup. Is Roundup international? Or is Roundup just Australian? Oh no, it's Bayer, German chemical and pharmaceutical company Bayer. There you go. I have learned something new today. I always assumed it was 3M that owned Roundup. And I just saw that announcement. I went, oh, that's probably why 3M rallied, but I'm completely wrong. There you go. And I'm going to be honest with you. Yeah, I thought 3M was a chemical company, multinational conglomerate, industry, worker safety, healthcare, and consumer goods. What is 3M famous for? Okay. Initially incorporated as Minnesota Mining and Manufacturing. There you go. Most famous for adhesive tape, audiovisual equipment. Gee, they do a lot. Reflective coatings and signs. Okay, so I have learned something today. And to be honest with you, as someone who just decided to trade 3M, I much prefer this little rally in the share price on the back of positive earnings update over this court ruling. So this is actually better than I expected. But anyway, a really good looking chart for 3M, and I'm pleasantly surprised. And yeah, we can all make mistakes. We're all human. And there we go. I made some assumptions about Roundup and 3M, and I was completely wrong. Anyway, that is all I have for today's video in regards to a technical update video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. And the last thing I should mention here is sometimes market can move you in the right direction, can guide you in the right direction. I had no idea this was going to happen with 3M, but possibly the market said, hey, we expect a possible earnings surprise from 3M. And that's why the share price or the trend in the share price and the sentiment in this company has shifted. And it shifted in about 3 or 4 months ago. So there was a bit of time here. And so sometimes just looking at these sort of setups can lead you in the right direction. Okay, so that's all I got for this particular video. Have a good day. Bye.